Good morning and welcome to Bloomberg Daybreak Europe. I'm Kriti Gupta in London. Let's get to the top stories that set your agenda. Stocks and bonds selling off in the States after U.S. inflation came in hot for the third time in a row. Traders testing key levels from the 10-year Treasury to those Japanese yen levels. Next up, it's all about the ECB. Rate cut bets getting paired as overnight volatility surges in the euro. We are live in Frankfurt. Plus, oil back in focus after the United States warns of imminent strikes on Israel by Iran or its proxies. Negotiations on a ceasefire and potential prisoner swaps are ongoing. Now, a quick check on the markets here as we digest a lot of not only the geopolitics, but the monetary policy as well. Take a look at futures right now. A little bit of outperformance in Europe. And I say this with a gigantic wagon of caution here, or wagon of salt, pick your phrase. Euro Stoxx 50 futures virtually unchanged after a major sell-off in the States. Remember, Europe also outperformed in the States in yesterday's session. So to see a continuation of that in the face of higher inflation is interesting. How much of that is a reflection of what we may hear coming out of the ECB today? FTSE 100 outperforming this morning, higher by about 0.3% when you look at the futures picture. Again, back to the States, seeing really virtually unchanged movements given that 1% sell-off you saw on the third in a row hot inflation report, 52.08 on those S&P contracts. That's just the equity picture. Let's talk about the cross-asset picture as well, because the bond market is fascinating here. We have officially crossed 4.5%, 4.52 on that 10-year yield. You're seeing a little bit of a bid into bonds this morning, down about 1 basis point on that yield. But again, we saw a move above 4.5%, a 20 basis point move in just one session. A Treasury auction, FOMC minutes, and then, of course, the US CPI numbers as well. We're going to dive into the details shortly. The currency read through is interesting. 107 on euro dollar, starting to see some weakness again in the euro. Is that anticipation of those potential cuts coming from the ECB? Cable as well seeing some weakness, 125 there. Again, virtually unchanged this morning, but it's really a reflection of what you're seeing in the yield picture. And Brent crude back above $90 a barrel. Let's see how those Asian markets are faring. The first to really digest what happened in the U.S. session. David Inglis joins us from Hong Kong. David, this is wild. Walk us through the reaction, the ripple effects in the APAC region.
It is pretty wild. It was pretty wild, I think, at the start of the session, and we're about, give or take, about 6 hours into the session now. So midday, we're coming out of the lunch break in Hong Kong, just for, I guess, some context right now. So we did open very weak just about across the board. But since that point, we've actually started to reverse some of the earlier weakness. In fact, at these levels, we're actually doing okay, which I guess goes to show from an equity market perspective, and you were showing, of course, futures just now, it does seem we might be able to shake off these cobwebs in a couple of hours, just looking at direction. Now, I can't say the same thing, though, when you look at your other point in the bond markets. In fact, we were bantering on shows today here that if you're feeling depressed looking at the equity markets, all you have to do is look at the bond markets. You're going to feel much better. And these yields, of course, are this melt up in yields we're seeing across just the Asia Pacific. And we can talk about currencies in a moment. That's really, Kriti, where you're feeling the pain right now across these sovereigns. 13 basis points. You don't normally see that across the likes of Aussie and the Kiwi yields, for example.
Yeah, the global bond volatility story certainly having ripple effects around the world. This is interesting, again, because then it has ripple effects into the dollar and what it means for the currency story. The 10-year, not the only one that is higher. Talk to us about the yen here. Talk about that ripple effect.
Yeah, that's interesting because we woke up in Asia with a yen at above 153. And since that point in time, as you can see, we've actually glided lower as far as dollar yen is concerned. If you look at the yen, not just against the dollar, against other peers, for example. In fact, the yen is actually stronger against the likes of the euro, the pound, for example. But I guess in some ways, the threats of intervention is on the top of minds of traders. Some language coming through this morning out of the Japanese officials. And just to recap some of these lines, right? Recent moves have been rapid. Moves from the start of the year have been significant. And the benefits of a weak yen have been decreasing. So the tone and the terms that are coming out of Japan are slightly firmer in terms of tone. Now, we've yet to hear the word bold, because that tends to indicate that things have escalated as far as sort of the warning system is concerned. So it's still been diplomatic, but traders are paying attention to that. All that being said, rate differentials will still push the yen to where it is right now. In fact, HSBC came out early this morning, just to mention that as well, and they've actually revised lower some of their forecasts for Asia FX because of that print, the CPI print that came out of the U.S. Kriti.
It's fascinating that we're talking about kind of what those levels to watch are, because there was a consensus that would be around 152, then 153, then 155. There's these technical levels that seem to mean different things to different people, and that doesn't even take into account some of the other kind of cross factors that you're seeing from China, from Korea. Let's zero in on China, though. What do we know there, especially in the context of inflation? Is China indeed exporting deflation to the rest of the world?
They could, because it goes to show, I think, to the question you just made. We were having this conversation earlier on with an economist from Hang Seng Bank, right? So the fact that you're getting, and I'll talk about CPI in just a moment. So PPI came in at negative 2.8%. I think it's a 17 or 18 straight month that we've actually seen a negative print there. That basically tells you there's idle capacity in the industrial sector. One way that China is able to then move the needle in growth is export some of that excess capacity, right? That goes into the deflation conversation. Now, this is also interesting because the CPI report came out a few hours, about half a day after the US CPI print. Both were on opposite sides of the spectrum, but both told you the same story, an inflation number that's actually bad for risk assets. So at 0.1% on CPI, actually missed every single forecast with the exception of one. So virtually no inflation, consumer inflation in China. The PBOC had to then come out, because of the dollar strength, with a record support as far as the daily midpoint is concerned, record spread relative to estimates. Now, all that being said, you look at the economics, you look at what the traders are doing, you look at forward points, for example. I'll end with this. It's actually getting cheaper and cheaper to short the Chinese currency. So the incentives are there, which is why mid-morning here, I'll end of this, that some state banks sold dollars in large amounts Thursday morning at the 723.50 level to alleviate some of the pressure coming through in the Chinese currency. Kriti, back to you.
Certainly a lot to digest there. David Inglis is in Hong Kong this morning. We thank you so much for walking us through those ripple effects that we're keeping such a close eye on. But let's zero in to the root cause there. It's all about that CPI report. Now the third one in a row. Bloomberg's Jill Deeses joins us now to break it all down. Jill, see a hot report once, shame on me. Hot report twice, shame on you. What does a third time mean? Is a third time the start of a longer trend? How is the Fed interpreting this? Is this still a soft landing story?
Yeah, look, Kriti, this one is really concerning. We could pretty much discount January and February as saying, okay, there's some seasonal factors that are playing into those hotter than expected prints, but I think people were really sort of expecting things to cool down by March. That's just really not the picture that you were seeing. You saw rises in rents and transportation in particular that really point to this issue of it's been really hard to stick to a disinflationary trend, and we're not seeing things come down in the way that you'd want to keep the Fed on track for its 2% annual targets. I mean, at this point, we've had some analysts saying you might have to prepare for a world in which 3% is really sort of where we're trending toward instead. I mean, looking at some of those core figures in particular, that 0.4% gain, I mean, that number for March matching what we saw in February during a time when you'd ultimately want to see something again sort of stick to a deflationary trend is really just not a fantastic picture for the Fed to be looking at right now. And I think really drives home this message that we have to be a whole lot more patient than we all thought we were going to be even just a few months ago.
It's interesting that we're talking about that as well, because then if you look at the actual data set itself, there's been a lot of questions that, well, we're just waiting for the labor market to actually soften up. But that's not where the inflation is coming from. This is a housing story at the core of it. Jill, how quickly does housing get fixed?
Yeah, exactly, Kriti. I mean, and that's really the problem here, is that when you're looking at some of these rent costs, I mean, this is what we had been talking about this week in terms of, keeping a look at some of those owner equivalent rent costs, primary rent costs. I mean, when you're not seeing any of that, taper down at all, that's where you really want to see some of that disinflationary trend kind of pull through to pull you to that annual target. I mean, if you're not getting there, then it seems like it's going to take a lot longer for inflation to come down. And it does seem like there's just not a whole lot of triggers that are really pulling down on those figures either. I mean, combine that with a lot of the other really strong data that we've seen out of the U.S. economy recently, those non-farm payrolls last week. We've saw, some other wage data that, shows a lot of that resilience in the labor market. I mean, this combines for a totality that really just tells us that, wow, the U.S. economy is incredibly resilient, and we're just, it's really, really changing the picture on when the Fed can actually start cutting rates.
Suddenly, the Fed has to be an expert in the American consumer psyche. What does the wealth effect then mean? Things like housing. And it's not really just about wages anymore. Bloomberg's Jill Desis, we thank you so much for walking us through that crucial story. Again, which is having ripple effects around the world. We talked about the American psyche. Let's talk about the European one and talk about the other major mover that is coming up in the next 24 hours. That, of course, is the ECB. We are live on the scene from Frankfurt. Our Bloomberg's Lizzie Burden joining us from there. Lizzie, is this the moment that the ECB front runs the Fed?
Well, Christy, only one of our 62 economists surveyed reckons that today is the day the ECB is going to fire the starting gun on cuts. But you are right, the US CPI report has rocked even ECB bets for a June cut. That was fully priced this time last week, and now it's only an 80% chance in the eyes of markets. What difference does a month or two make, you might ask? Well, if they go too soon, if they go before the Fed, then it risks euro-dollar parity, warns Mohammed Al-Arian, our Bloomberg opinion columnist, of course, and that could feed back into Eurozone inflation. But on the other hand, the risk of going too late, and this is a different picture here in the euro area than in the US, is it could tip it into recession. Even the most hawkish member of the Governing Council, Robert Holtzman, has warned of the dangers of holding rates too high for too long, because indeed here you haven't seen any growth for about a year and a half compared to the US, where you've seen that 3% growth last year. That's a stark contrast. So today the expectation is that Christine Lagarde will telegraph a June cut, but the focus in the press conference very much on the path beyond that and the divergence between the ECB and the Fed. Because think about it, if you get Trump in the White House, that could really stoke US inflation and leave the euro area in a very tight spot.
All right, Bloomberg's Lizzie Burden in Frankfurt. We thank you so much for bringing us that crucial context. She will be up there, of course, live for that ECB policy decision at 1:15 p.m. UK time, followed by, of course, what Christine Lagarde has to say in that news conference just half an hour later. And, of course, we'll also be speaking to Evelyn Herrmann later in the show, the European economist over at Bank of America Global Research. That conversation coming up in just about 15-ish minutes' time. A lot to digest there, not in terms of just the European policy, but what the ripple effects are for the currency as well. We're keeping an eye on the Treasury yield in the U.S., 453, and what that means for the FX story, but also what the commodity read-through is. Brent crude, $90 a barrel off some of the geopolitical tensions. We go there next. Stick with us. This is Bloomberg. The U.S. believes major strikes by Iran or its proxies against Israel could happen within just days. Now, Iran has threatened retaliation for an attack on its diplomatic compound in Damascus, Syria. There's a lot to digest here. Let's get into the nitty-gritty. Bloomberg's EMEA News Director Rosalind Matheson joins me on set. Ros, let's talk a little bit about this threat to begin with. How significant is it? Is this really that unexpected to begin with?
Well, Iran has been saying for days that it has to retaliate for this attack on its diplomatic compound in Syria. It viewed that attack as really an assault on its own soil because of the nature of it. It's been saying it's going to do something. So really now it does have to do something. The question is what? And what we know now is the US intelligence assessment of the US and its allies is that that retaliation could take a range of forms. It could be as unusual and strong as a direct missile strike by Iran on Israeli soil. That would be the big option. It could also take the form of going through its proxies in the region, again, Hezbollah or some such. But it's significant enough, the intelligence, that the US is willing to share it and to publicise it, which shows the level of concern that Iran is going to do something. Of course, we've been expecting it for days. The question is what? And it's very, very interesting to see the intelligence showing that a missile strike from Iran on Israel is possibly on the table.
It's interesting. We're talking about this just from a kind of financial network perspective, not to put aside the potential humanitarian toll added. But this is exactly what the oil markets are worried about, what the ripple effects are. What does this mean for Iranian output on oil for the rest of the market, which, by the way, is an inflationary story at the core of it. At the same time, you have to talk about where the negotiations with Hamas actually are on the hostages. There is calls repeatedly on ceasefires from the likes of President Biden and other leaders around the world. Where are we on those negotiations?
Well, it's interesting because, as you say, with oil, for example, this war in Gaza has been going on for 6 months. The disruptions to Red Sea shipping by the Houthis have been going on. Oil's not really reacted to that. After the strike on the Iranian compound, oil did react because now people are saying, hang on, this conflict could spread. This could become much more widespread in the region. It could pull in Iran, could pull in the US. Then you've got disruptions to supply. Then you've got a really big effect on the global economy. So people are worried about the knock-on effect, but they're also still worried about the conflict inside Gaza. And there, we still don't have a ceasefire. We do know Israel has pulled some of its troops back to prepare potentially for an assault on Rafah, but a lot of that depends on whether they can get these talks to get this ceasefire, and that depends on the state of the hostages. And what we can see from the reporting in the New York Times is that Hamas is saying they actually don't know where some of these hostages are. They don't know the state of many of them, and they can't guarantee that. And that's a precondition that Israel has said it wants met in order to agree to a ceasefire.
Of course, as the pressure around Israel's actions in the area are really ramping up, the Spanish Prime Minister, for example, Pedro Sanchez, really not mincing words when it comes to how he feels about the situation. Rosalind Matheson, our Bloomberg EMEA News Director, we thank you so much for walking us through the crucial story in the Middle East. I want to stick with the geopolitics, stick with the military threats around the world. The U.S. and Japan have unveiled plans to deepen their security ties. It comes as President Joe Biden hosted Japanese Prime Minister Fumio Kishida for an official visit aimed at countering China. I want to bring in Bloomberg's East Asia government editor, John Herskovits, this morning. John, pleasure to have you on the program. Talk to us about this agreement. Talk to us about the significance of it. This is historic in a lot of ways, but why?
This really, it resets the basic agreement between the U.S. and Japan, their security alliance, which dates back for decades. What this does is changes the way that the two militaries can operate jointly in Japan. It's called Operational Command. It's something like what is in South Korea, where the U.S. and South Korean forces can work as one unit under a joint command. At present, U.S. forces in Japan have a command structure that's set up with Indo-Pacific Command in Hawaii. What this would do, it would integrate the U.S. command into Japanese command and have the two militaries be able to work together to counter any threat and bring the two forces into much greater alignment. So that's the big picture. And it's also, there are a lot of other agreements that went on as a part of this, which include information sharing, training exercises. But the basic alliance between the U.S. and Japan will undergo this operational command structure change.
All right, Bloomberg's East Asia government editor John Herskovits there talking to us about the significance of this kind of military alliance at a time when, of course, the Philippines and China have really been ramping up the tensions there. How much of this has a broader regional effect? We'll be monitoring that situation. Coming up on the program, we go to South Africa. The rand tumbles as support for a new poll shows support plunging for South Africa's ruling ANC party. We're going to hear from the leader of the opposition EFF party. More from our exclusive interview next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. I'm Kriti Gupta in London. We are getting breaking headlines in the banking space. SocGen looks like they're going to be selling their equipment finance arm to Group BPCE for about 1.1 billion euros. Now, for our international audience, this is important because Group BPCE is or was at one point the fourth largest bank in France. SocGen, off the back of this deal, seeing a positive about 25 basis points impact on their CET1 ratio from the deal. The completion of the deal expected to occur in the first quarter of 2025. That would actually mean that in terms of the equipment finance activities, Group BPCE will actually take over. This looks from the initial read-through in terms of signing the memorandum of understanding, and the divestment here looks ultimately like a cash story. Does that additional cash on the SocGen balance sheet that would then affect the CET1 ratio help perhaps the stock price at the open. We're going to keep an eye on that in just about 90 minutes time. Now on to one of our top stories coming out of Africa. South Africa's rand fell after an opinion poll showed plunging support for the ruling African National Congress Party. The poll suggested the ANC, which has governed South Africa for about 30 years, may garner just 37% in the election at the end of May. Bloomberg's Jennifer Sabasaja joins us from Johannesburg. She is all over the story. Jen, walk us through this currency reaction. What are they seeing?
Yeah, Kriti, I mean, this is really significant because what we were seeing from the rand, it was at its best levels of 2024. And actually, the drop that we saw on Wednesday had halted a 3-day rally for the rand. And as you mentioned, this is really coming after this opinion poll that is showing that potentially the ANC is not going to get this 50% majority that we've been talking about for the past few weeks, but is actually going to drop below 50%, which for many investors, this just continues to spell more uncertainty because then what does that actually look like? That would mean potentially we are gearing up for a coalition government. It really depends on which parties that you're talking about, what that could mean for investors. And so, we're seeing the rand right now, if you take a look at that chart, pulling back just a bit slightly, but it just spells even more uncertainty. And we got a little bit of that even when we spoke with EFF party leader. The EFF is one of the biggest parties here in South Africa. It is led by, his name is Julius Malema. He is a very bombastic, charismatic person, but he was even saying his expectation and his polls are showing that the ANC will likely not get 40%. And so really investors are paying close attention to what this means for the May 29th election.
And Jen, you spoke with the leader of the EFF party yesterday. Talk to us about his view about his chances in the election.
Yeah, I think it's important to put into context who Julius Malema is. He used to be the ANC youth leader, so he worked very closely with former President Jacob Zuma and really has just gained more and more popularity over the past few years as the EFF party leader. And as I mentioned, it's one of the main parties that is contesting in this election. And listen to what he told us about his former boss, who is now able to run in this election. Take a listen.
Our base has never been based on the basis of the love and support for Jacob Zuma. So why would something that was not based on his love and support be threatened by him? We are a national organization. We have had successful rallies in all provinces, and we are the only organization after the ANC that has got membership and presence in almost all municipalities in South Africa and exist in every corner of South Africa. We welcome President Zuma to the terrain. Let him come, but he knows himself by now that it's not easy to form a political party.
Yeah, so that was just part of what Julius Malema was telling us. And I think it's important to note for investors, we've done a few polls here internally and shown that investors are very weary about a potential EFF-ANC coalition. The EFF, just for some context as well, has been for land expropriation without compensation. They want to nationalize the mines and also the Reserve Bank. And so this is a party that has really gained a lot of popularity here in this country. And the question is, what does it look like going forward? What does a potential coalition look like with some of these parties, Kriti?
Bloomberg's Jennifer Sabasaja all over that story. We thank you so much for bringing it to us. Of course, she will be anchoring as well the South African election special edition of Bloomberg's Africa Amplified next month. You can catch that on May 3rd. Coming up, we speak to Evelyn Herrmann from Bank of America Global Research. It's all about the ECB. That conversation coming up shortly. Stick with us. This is Bloomberg. Good morning. Welcome to Daybreak Europe. I'm Kriti Gupta in London. Let's get to the top stories that set your agenda. Stocks and bonds sell off in the States after U.S. inflation came in hot for the third time in a row. Traders testing key levels from the 10-year Treasury yields all the way to the Japanese yen. We're going to dive into the market reaction. Next up, it's all about the ECB rate cut bets getting paired as the overnight volatility surging in the euro. We're live in Frankfurt on decision day. Plus, oil back in focus after the U.S. warns of imminent strikes on Israel by Iran or its proxies. Negotiations on a ceasefire and a potential prisoner swap are ongoing. A quick check on the markets as we digest all the headlines in the geopolitics and the monetary policy as well. When you look at the stock market, though, remember a 1% sell-off in the U.S. equity picture, not having much of a read-through when you look at what's going on in the European session. In fact, Eurostoxx 50 futures are virtually unchanged. Remember, they were the outperformer globally in the last 24 hours. FTSE 100 is the real story, though, higher by 0.3% in the future story. We're going to dive into what that actually looks like in just about 90 minutes' time. S&P futures, in the meantime, unchanged. You're not seeing a major bid despite the sell-off yesterday. 52.08 is what you're seeing in S&P futures. To me, it's the cross-asset story. That's really where all the action is, especially when it comes to the bond market. 4.53 on the 10-year yield. Remember, just at the beginning of this year, more of the kind of strategists, investors, economists that we spoke to expected 3.5% on the 10-year before we got to 4.5%. The fact that we've gone to 4.5% before 3.5% is actually the contrarian view, and nevertheless spurring questions of do we hit 5% before seeing that cuts actually take place, which puts the focus on the ECB. Perhaps that's why you're seeing a little bit of weakness this morning in the euro, partially offsetting some of that CPI action as well. 107 on euro dollar, continued weakness in cable as well, 125 there. And Brent crude, not doing a whole lot. $90 a barrel, though. Those geopolitical tensions, how inflationary are they? We will, of course, digest that throughout the show. But really, it all comes back down to the CPI story. You would think it's services different. You would think it's commodity driven. Plot twist, none of the above. In fact, it's housing driven. It's airlines driven. Mark Cranfield is all over the story, and MLive strategist monitoring the ripple effects of this inflation report very, very carefully. Mark, a pleasure to have you on the program. This is a concern in terms of being data dependent, in terms of transitory inflation. Two data reports, two hot inflation reports, maybe could be counted off as a one-off. Can a third hot inflation report be kind of thrown to the side by the markets?
No, and it's not just a problem for the US. It's a problem globally. You can see the read across. You were saying that there's a bit of a limited read across in some assets, but if you look across global bond markets, including Asia today, the reaction is very strong. There's a backup in yields everywhere, Australia, Japan, across the rest of the Asian region, and you're probably going to see a bit more as the European markets begin their day shortly. And you can see that it means that central banks everywhere are probably now having to reassess what they're going to do with their own rate decisions in relation to the fact that the Fed now probably has to go a little bit slower than even the dot plot suggests. So in Japan, for example, here we're seeing the 10-year Japanese bonds having their worst day so far this year. There's no sign yet that the Bank of Japan is coming in to defend that market, which is as an unusual time. They're probably just saying to themselves, well, we don't know where the peak in Treasury yields is going to be, so there's no point in us wasting our bullets just yet in stopping the Japanese market, particularly as there could be more rate hikes to come this year in Japan. So you can see the read across is pretty strong in bond markets. FX markets have been a little bit more steady, but under pressure in Asian currencies as well. Chinese currency is getting pretty close to the top of its trading band today. And as you say, dollar yen is not as high as it was yesterday, but it's not far away. And we haven't yet seen any actual intervention. We've seen plenty of verbal intervention today. Japanese authorities are very concerned about yen weakness. So the ripple effects across asset classes are still going through. And obviously there's going to be more to come today because you've got the European Central Bank coming up. And they've also got major decisions in terms of how far are they going to be affected by what they've seen in this CPI report as well.
MLive strategist Mark Cranfield walking us through that read-through. We thank you so much for talking us through the ripple effects. And he was there talking about dollar yen. We're also keeping a very close eye on euro dollar as well. We're trading right now at about 107. How much of that is really a CPI story as opposed to caution ahead of the ECB? We are live in Frankfurt. Bloomberg's Lizzie Burden joins us from the European Central Bank. Lizzie, talk us through some of the risks that come with front-running the Federal Reserve.
Well, Critty, if the ECB goes before the Fed, and it could, ever since its inception, it's warned us, it's reminded us that it has its own mind. You had Finland's Olli Rehn saying that the ECB is not the 13th Federal Reserve District. Then there is the risk, as Mohammed El-Arian, our Bloomberg opinion columnist, warns, of euro-dollar parity, and then the risk that that feeds back into euro area inflation. But other economists that I speak to say, look, this is only ever going to be a temporary divergence. It isn't something that the ECB is talking about at the moment, the worries about exchange rate volatility, although this really will be a focus when we listen to Christine Lagarde at the press conference after the decision. As well, you need to listen out for clues as to the path beyond June. But the expectation is very much that the cuts are not going to start today. June is the date that they'll begin.
So, Lizzie, what are they watching, though? When we're talking about kind of these labor market concerns around the world, the ECB has a very different mandate than a lot of these other central banks. What is the kind of inflation canary in the coal mine when it comes to this region?
Well, you bang on to talk about jobs and wage growth, Critty. Inflation as a whole has been retreating towards the 2% target. It looks like, to some economists and policymakers at least, you could be below the 2% target by the summer. But if you break that down, services inflation really has been persistent. It's been around the 4% mark since November. And within that, wage growth, as you say, is the concern. Christine Lagarde herself has flagged it, and she's pointed to the June data as being really crucial and maybe a reason to wait until June. So services, the thorn in the side. But on the flip side of that, you've had weak growth. And this is the difference between the euro area picture and the US picture. Here in the euro area, the economy has barely grown for the past 18 months, whereas the US, as you know, has grown 3% last year. So it's a stark contrast. And even the most hawkish member of the Governing Council, Austria's Robert Holzmann, has talked about the perils of waiting too long. François Villeroy de Gallo of France has talked about the need for an insurance policy against the risk to growth. And this is why it's a two-sided risk.
Bloomberg's Lizzie Burden in Frankfurt. We thank you so much for previewing that decision. Coming up at 1:15 p.m. UK time. And as we say, we are, of course, watching the currency picture very, very closely. I want to get a little bit more analysis, though, and bring in a true expert. Evelyn Herrmann, European economist over at Bank of America Global Research, joins us this morning. Evelyn, a pleasure to have you on the program. Thank you for waking up early for us. Talk to us a little bit about this read-through. Lizzie there was talking about the risks of the ECB front-running the Federal Reserve. There are still a couple calls out there that today may be the day for a cut. If not today, when?
Yeah, we think today is a bit too early indeed for cuts from the ECB. They did flag very clearly that they do want to see the wage data over the coming weeks and months. They do want to see inflation move lower to target. They all seem to have zoomed in on June. So for us, June is really the moment for the ECB to start their cutting cycle. They probably have a rather shallow cutting cycle in mind. Then. So April to early June will be the moment when they will move. Calendar-wise, that would be before the Fed anyway. One thing we would point out is that the ECB really is facing a very different economy. We have a lot more disinflation in the euro area already. We do have a weaker economy. The labor market is probably not as tight as unemployment rate suggests. All that matters for the central bank. And with that in mind, the ECB will probably not have much of a choice to engage into a cutting cycle, even if the Fed were to delay their cutting cycle. We've seen divergence in the past. If you think back 2015, the Fed started hikes. The ECB actually cut again and then launched their QE program. So we did have cycles where the two central banks have actually diverged quite meaningfully.
Evelyn, we're talking a little bit about that divergence story and how you kind of factor it into the markets, price it into the markets even. There is a question that if you do see that front running of the ECB, ahead of the Federal Reserve, this is kind of where you start to see real weakness in euro dollar. That the case for parity in euro dollar is based on this cut story in its entirety. Is the ECB paying attention to what the euro is doing?
It's part of, the euro exchange rate does enter the inflation profile via import prices. So from that perspective, I won't say it doesn't matter at all, but it can't be their primary concern. If really we are facing an economy that, from a domestic perspective, cannot deliver 2% inflation, and in our opinion we're heading that way, we're heading towards an undershoot in 2025, the exchange rate to that one will be second order. So from that perspective, the ECB really needs to look at the domestic economy to do what's right here, and the exchange rate will be an exogenous factor almost to that one then. I wouldn't rule out that some of the hawks, if we were really to see a substantial euro weakening, were starting to talk about the exchange rate again. But again, from a monetary policy perspective, if inflation is your target, you need to look at your domestic economy. And that one is sufficiently weak in the euro area to require these rate cuts.
In terms of what they are factoring in, though, how much does monetary policy even matter when you have this fiscal impulse, money being pumped into some of the periphery economies, Greece, Italy, Spain? Does monetary matter when so much of the fiscal is, in a lot of ways, propping up some of these economies that are most at risk?
Monetary policy does matter. We did see it. Inflation is coming down. We have seen a pass-through of monetary policy very fast, actually, in terms of lending rates to the economy. In terms of fiscal policy, you still have support from programs like NGU, but you don't get more support from a year-on-year comparison. And that hasn't actually prevented the euro area in total to have very weak growth only. So monetary policy does matter. It does matter for funding costs. We've seen in lending rates to the economy that we've reached a credit impulse, so a change in year-on-year new lending to the economy that has basically hit zero. We've seen in the bank lending survey just earlier this week that actually the appetite of firms to lend, to take up loans from banks has reduced even further on the back of higher funding costs. All of that also matters for capex in the economy. So monetary policy still matters, even if fiscal policy has been relatively supportive in the past. The question is also, will it matter going forward? And then we can open the entire debate around fiscal rules. If we're heading into a trajectory in which public finances in the euro area will be going on an adjustment path, even if it is relatively shallow, we will get less support from fiscal policy, small corrections. What happens if we ever have to face a next crisis? And then monetary policy would probably be in the focus again. So yes, we have evidence monetary policy is working. The policy mix has been supportive in the euro area until the hiking cycle started to kick in, but on a cumulative basis, we would argue at the moment we are in a very restrictive environment from a policy mix perspective in the euro system indeed.
Evelyn, one of the criticisms of the ECB at the moment for the folks that are saying a cut is in, if not today, in the near future for the ECB, is that they are catering more to the German economy than to perhaps the periphery, the Spain, the Italy, the Greece that we were just talking about, that is actually outperforming at the moment. What do you say to that the ECB is catering to the sick man of Europe?
I would question that a little bit because we've seen disinflation broad-based in the euro area. So again, you can have strong growth, you can have decent growth rates, and yet you can have inflation dynamics that are insufficient. And that's something we have in common across the euro area. If you look at wage dynamics, we've seen wage growth coming lower in very many economies. Actually, Germany is the one where, at least if you include one-off payments, it's standing out as a little bit more sticky. So from that perspective, I really wouldn't argue the ECB today is catering to the German economy. If anything, we've had a substantially more economic weakness in the German economy compared to other economies, and it's one where the national central bank, the Bundesbank, has actually been pushing back against rate cuts for a very long time. So that criticism at this stage, I think, would be a little bit overdone. Is the ECB waiting too long for rate cuts, given that 4% is a very high level for nominal interest rates in the euro area, given neutral is probably closer to 1% where it was including prior to the pandemic? That yes. And from that perspective, it's something that affects the euro system as a whole. We do see inflation coming lower. We do see inflation coming lower everywhere. And that is the part the ECB needs to react to, because we're currently on a trajectory whereby an undershoot, including in core inflation in 2025, for us, is the most likely outcome.
Evelyn, Herrmann, we have to leave it there. I could talk to you for hours, but we thank you so much for making the time this morning. European economist over at Bank of America Global Research. A reminder, of course, that we're going to bring you live coverage of the ECB's policy decision at about 1:15 p.m. UK time, followed by Christine Lagarde's news conference just in half an hour later, 107 on Eurodollar as we approach that decision. Coming up on the program, the Swiss government unveils sweeping measures to reform bank oversight and takes aim at UBS chief Sergio Armati's $16 million salary. That story next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. We go to the Swiss banking sector next, where UBS faces a substantial increase in regulatory capital requirements as the Swiss government unveils sweeping reforms for the banking sector following the collapse of Credit Suisse. Take a listen to what the Swiss finance minister had to say.
The highest goal of the Federal Council is to protect the taxpayers and the economy. What happened with Credit Suisse must not repeat itself. It must be prevented that a banking crisis becomes a threat to the Swiss economy. Regarding bonuses and management, those responsible for mismanagement must be held accountable. That means it must be possible to cancel bonuses. It must be possible to recall them retroactively too. This is not about punishment, but prevention.
Bloomberg's Bastian Benrath joins us now. Bastian, pleasure to have you on the program. Talk to us about the Swiss banking reform. What's in it?
Well, the Swiss government looked at a very specific problem which came up during Credit Suisse's demise, which is the capital backing of foreign subsidiaries of big banks. So you have like banks like UBS or Credit Suisse at the time who have like a large international presence, have subsidiaries in the US and the UK. Under the current rules, UBS only has to back them with 60% of their capital. The Swiss government said very specifically that they want to increase this, because the problem at Credit Suisse was that during the crisis, a sale of these foreign units, which would have helped the parent company, was essentially out of the question, because that would have essentially lowered the parent bank's capital ratio. So this is what they want to look at. And they said that they are aiming for a substantial increase of capital requirements also on the group level for UBS.
The reform also has a lot to say about FINMA, what it can, what it can't do. With the former CEO of FINMA on a couple of, I want to say, weeks ago around what the regulation authority should actually be able to do. Talk to us about to what extent its hands are tied or not.
Yeah, so they are looking at holding, we just heard it from the finance minister, they are looking about holding rogue managers accountable. What they have said, what the FINMA management has said is, guys, we talked to them for more than a year and they just wouldn't listen to us. They just tried to delay the process, and Credit Suisse executives, they just, like, we told them they need to make changes, but they didn't listen to us. So what they are now going for is a so-called senior manager regime. This is something which is in place in other jurisdictions, for example, in the UK or in Hong Kong. And it essentially says that prior, like in advance, it needs to be laid down what manager is responsible for what. So if there is like rogue behavior or a failure in a certain unit, then we know this manager is the accountable one and needs to be punished, held accountable, whatever that might mean. However, they are not looking at pecuniary penalties. So they are not going to slap fines on individual managers. And this is the point, also not on banks. The possibility to fine banks is more or less standard with all international financial regulators. But the Swiss financial regulator, FINMA, will also in the future not get this power. Kalasuta has said, the finance minister has said, that they are still looking at it. It is something which could come in the future. It's examined. It's not totally off the table. But for now, they are saying, if you slap fines on lenders, that's not going to help. It's just going to, the bank is going to pay the fine, but like it's actually not going to change their behavior. So they're really looking at like holding managers accountable with this senior manager regime. And they have some sharp weapons against them, short of pecuniary fines. They could, for example, ban them from their jobs, like say you can't work in the banking industry anymore. So this is what they are looking at, and they especially want to be able to establish a clear line of accountability that's at the core of the new powers for the financial regulator FINMA.
And we'll, of course, see how far they get, especially when it comes to kind of targeting salaries and kind of penalties as well. Bloomberg's Bastian Benrath, we have to leave it there. We thank you so much for that crucial context around the Swiss banking sector this morning. Plenty more ahead. This is Bloomberg.
You have to take seriously the possibility that the next rate move will be upwards rather than downwards. And anything could happen. Markets could crash, the indicators could turn down. But on current facts, a rate cut in June, it seems to me, would be a dangerous and egregious error.
A dangerous and egregious error. Some big words coming out of Larry Summers there, who's saying, look, there may actually still be a case for a rate hike on the table. Not just pausing, not just pushing cuts out, but a rate hike altogether. Here's what the markets are doing. They're taking those comments in stride when it comes to those rate cut bets. This is just for June. Remember at the start of the year when we were expecting 6, 7 rate cuts? Those odds have diminished more and more. After yesterday's inflation report, down to less than 20% for a cut in June. That doesn't necessarily speak to the hike story, but here's where we are keeping attention. What does the ECB do today? Is it more of a reaction in the CPI numbers? And that volatility is crucial when we talk about it being at its highest, not just in a year, back to March of 2023. Those all, of course, in focus as we get closer and closer to the ECB decision. We, of course, also have a supreme amount of great guests as well. The Telecom Italia CEO will join us in the 9 o'clock hour. Plenty to digest. Stick with us. Markets Today is up next. Anna Edwards, Guy Johnson joining me to break down the market stories of the day. We're going to get your day going and prepare you for the European market open. Stick with us. This is Bloomberg.